Okay, two types of policy. Policy, again, is the actions of government. It doesn't matter what type of actions we're talking about. There's different types of policy that government does. Foreign policy, domestic policy would be policies of the United States. Fiscal policy, monetary policy are the two economic policies our government does. Okay, we see presidents talk about this all the time. People in Congress talk about this all the time. Local people talk about this all the time. People care about the economy, right? When people vote, typically people vote based off economic issues. So when we're talking about policies, this is usually a pretty important one, right? Generally, no matter what type of policy we're talking about, you see at the very top here, fiscal policy, monetary policy. Fiscal policy, monetary policy, you can do two things. You can increase or decrease. Now, it depends on what exactly you're talking about, but there's only two things you can do. Increase it or decrease it. For fiscal policy, we're talking about taxing and spending, right? If we're talking about taxes, we can increase taxes, we can decrease taxes. If we're talking about spending, we can increase spending, we can decrease spending of the government. Now, some things, remember, you can't decrease spending on. Mandatory spending, you can't decrease. So we're talking about decreasing or increasing spending. We're talking about discretionary spending, all right? But this is taxing and spending policies of the government. The goal, we want to provide funds for the government without affecting the economy. Because again, we need funds, as we talked about last time. If we don't have funds in the budget, then things don't get done. So, if the economy is growing slowly, what could the government do? President could do this, Congress could do this. We're not talking about taxing and spending, right? Well, if the economy grows slowly, then we probably would see tax cuts, because if there are tax cuts that happen, then us as individuals, consumers, we have more money, and what are we going to do with that money? We're not going to go put it in the bank, because nobody puts money in the bank. We go and spend that money, right? Now, the other thing they could do is talk about spending. Well, what could we do with spending? Well, if taxes are going down, then we probably don't have as much money coming into the federal government. So what's going to happen with spending is we're also going to see spending for that government go down. If we decrease taxes, if we decrease spending, then that might help the economy to start growing at a faster rate. Now, it doesn't necessarily mean that's going to happen, because this is all based off of theories, right? Theories, we don't exactly know if it's true or not, whether it's science theory, or whatever. You have a good idea about what might happen, but you don't necessarily know for sure if it's going to happen, right? But we're hoping we could then affect fiscal policy by decreasing taxes, decreasing spending, to then hopefully help the economy grow a lot faster. Now, the other type of policy is called monetary policy. Monetary policy is controlled by this building down here. You see it? It's the Federal Reserve, right? The Federal Reserve is an independent part of the executive branch, really. There's a governor of the Federal Reserve Board. If there's an opening, the president will select somebody to be on that new member of that board of governors for the Federal Reserve. These are all people that have extensive amounts of economic experience, right? They serve 14-year terms. They're going to be very influential when we're talking about monetary policy, because this is only controlled by the Federal Reserve. Think of the Federal Reserve as like a national bank. It's not a national bank. It's not a central bank, but it kind of does those things without being one of those things, which is kind of weird. But again, we're talking about surface level economic theory, so we don't need to get into the discussion about is it a bank or is it not a bank. It does help to regulate banks. It does give the money supply to banks, right? The money that you have in your wallets, in your pockets, if you look at the top of it, it says a Federal Reserve note, right? Federal Reserve note means it comes from the Federal Reserve. They print our money, right? So they control the circulation of the money. And that's one of the things that monetary policy does, right? Is how much money is there The supply of money is there for the population. We don't want too much money out there, because if we have too much money out there in the circulation, then we're going to see a devaluation of the currency. That leads to inflation, right? Inflation is a bad thing. It makes your $20 bill not exactly worth $20. We don't know that at the time, but in the future, we're going to see the effects of what inflation can do to the value of our currency, right? Again, there's two things we could do with the circulation of money, or the money supply, right? We can increase the money supply, we can decrease the money supply, and that's all we really can do. We're trying to do this to eventually what can be done to help the economy to continue to grow, because as we saw with those 4 basic goals of economics, we want the economy to typically always grow, right? So outside of supply of money, monetary policy also controls interest rates, or the Federal Reserve also controls interest rates. When we talk about monetary policy, it's money supply and interest rates. Interest rates, it's all about how we borrow money from banks, right? When you borrow money from a bank, you have to pay back that loan. You don't just pay back that loan, you pay back that loan plus interest, right? This has a way of trying to affect consumers. If interest rates are low, they're trying to help jumpstart the economy. Right now, with the stoppages of industries, the stoppages of workers, you see the stock market going down. People are concerned about the economy. Well, the other day, the Federal Reserve pretty much made interest rates next to zero, right, in hopes of restarting or jumping some of the things with the economy to help it kind of recover, so that way it doesn't keep sliding down a slippery slope, right? If interest rates are high, then we as consumers don't want to spend our money, because we're going to be paying more things back if we're taking out large loans for buying cars, homes, college loans, those types of things. If their interest rates are low, we're incentivized to do these types of purchases, right? So interest rates have a lot to do with what then does the consumer do, right? So both of these things together create monetary policy. The Federal Reserve is who